Most traders right now are losing money, and they don't even know why. They have strategies, they have indicators, they watch the news, they follow signals, and they still end up with less money at the end of every month than they started with. Today I'm going to tell you the real reason this is happening and exactly what you need to do to fix it. Stay with me because this video could completely change the way you trade. Welcome back to the channel. If you're new here, this channel is dedicated to one thing: helping you become a consistently profitable trader, not a gambler, not someone chasing setups, a real trader with a real edge. And today we're going to cover everything: supply and demand zones, smart money concepts, market structure, entry confirmation, risk management, and the most important piece of the puzzle that almost nobody talks about, your psychology. Let's get into it. Let me start by giving you the picture of what's happening in markets right now because context matters. We are in May 2026 and markets are behaving very differently from what traders experienced in the easy money era. In 2025, AI stocks, tariff policy, and Federal Reserve rate cuts were driving everything higher. Traders could buy almost anything and make money. That era is over. Right now, central banks have stopped cutting rates. The Fed is holding, the ECB is holding, and that creates a very specific market environment, one where moves are sharper, reversals are faster, and emotional traders get punished quickly. Volatility is elevated across both stocks and Forex. S&P 500 valuations are near historic highs. Geopolitical tensions in the Middle East are affecting oil and inflation expectations. Tariff negotiations between the U.S. and its trade partners are resuming. All of this creates noise, and noise kills retail traders because retail traders react to noise while professional traders ignore it and focus on price. That brings me to the foundation of everything we're going to cover today. Price moves because of one thing: imbalance. When there are more aggressive buyers than sellers, price goes up. When there are more aggressive sellers than buyers, price goes down. This is not complicated. This is market mechanics. The problem is that most retail traders never learn to read this imbalance. They're too busy looking at RSI, MACD, moving average crossovers, and Fibonacci levels. All of those tools are derived from price. None of them tell you what's actually driving price. Supply and demand zones tell you where the real orders are sitting, where institutional money, banks, hedge funds, smart money has placed its positions, and that is your edge. Here's how supply and demand zones are created. When a big institution wants to buy a massive amount of an asset, they can't buy it all at once. If they did, they would move the market against themselves, so they place large buy orders at a specific price level. When price comes to that level, those orders start filling, but sometimes price moves away before all the orders are filled. The unfilled orders stay at that price level, and when price comes back to that level, those orders activate again. That level is your demand zone. The same thing happens in reverse for institutions selling. They place large sell orders at a level. Price moves away before everything fills. Those unfilled sell orders create your supply zone. This is why price respects these zones. It's not magic. It's not a pattern. It's real institutional money sitting at those levels waiting to be filled. Now let me teach you how to identify a real supply or demand zone versus a weak one that won't hold. A strong demand zone has three things. First, price leaves the zone fast and impulsively. When you look at the chart, there should be a sharp explosive move away from the base. This tells you buyers were very aggressive. Second, the base before the move is tight and clean. 1 to 3 candles of small consolidation before the impulse. If the base is messy and wide, it's not a clean institutional zone. Third, the zone is fresh. It has not been tested before or has only been tested once. Every time price visits a zone, some of those institutional orders get filled. By the third or fourth visit, most of the orders are gone and the zone breaks. The same 3 rules apply to supply zones in reverse: sharp impulsive move down, tight clean base, fresh or first test only. When you're drawing the zone on your chart, keep it simple. For a demand zone, mark from the low of the base candle to the high of the base candle, or the open of the first big bullish candle. For a supply zone, mark from the high of the base candle to the low, or the open of the first big bearish candle. Don't overthink it. The zone should be clean and obvious. If you're spending 10 minutes trying to figure out where the zone is, it probably isn't a strong zone. Strong zones are obvious when you know what to look for.